Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our EIA show, and we're going to go through in our normal 3 segments, an overview of what's happening in the U.S., just looking at what happened with the numbers, what do they mean, a deeper dive on what's happening with products within the U.S., demand, and then in the 3rd segment, going abroad and looking at the energy markets, holistically, if you will, just looking at oil, refined products, how are things moving about, where are we seeing builds, where are we seeing draws. And one of the things that we just wanted to look at right before we get started was obviously please like, share, subscribe. That is always helpful. And then on the other side, when you look at what the data shows, and there's a sell-off in the market right now, and it's really because Cushing had a small build. But one of the things that we've been highlighting and we talked about last week was PADDI 3 is where there's still a fairly large above normal amount in storage, or above the 5-year average. So when you're looking at, okay, well, the tax man comes next month, so how do you start to move this about in order to reduce your underlying tax bill? So that's one, try to increase exports, try to moderate imports to what you need in terms of at-time deliveries, as well as best as possible, because you have to move stuff through, while at the same time pulling down some of that oil inventory, creating product, putting it onto the Colonial Pipeline, getting it into PADDI 1, because PADDI 1 still has the biggest shortage when we look across the board. That's including distillate, that's gasoline, crude. So there's ways to try to manage that. So that's where the Cushing shift, and that's the other thing. It's instead of bringing it down to PADDI 3, just leave it in Cushing. Just keep it just north, and you can avoid some of these additional charges. So these are some of the things that we see that are continuing to shift. And as we talked last week, we see a huge amount, or a big increase really, of the amount of crude on the water. That's a mixture of what is in transit and what is in storage. And some individuals have questioned this data, but again, it's for Texas, and they're using AIS transponders. Like, there's not a lot that you can do to get around that. Satellite imagery can be a little touch and go, depending on, was there cloud cover, how is the algorithm in terms of calculating shadows. So that's why we try to stick closer to what is being reported based on the AIS transponders. And that's something that we showed on Twitter at the beginning of the week, and what we really indicated last week, and is starting to come to fruition as we had been discussing. So this is one of the things that we like to look at when we look at it holistically. So stockpile deficit narrowed from 21 million to 7.3 million barrels. So that'll get a little bit tighter again, just because we had another build in Fujairah. We had, and then we want to see what happens with Singapore and in Europe. But right now they look like they're going to see a little bit of a build, especially in Singapore after seeing a nice drop. And then the U.S. saw a fairly steady drop across the board in both gasoline and diesel. So that'll keep, again, when we look at total oil product stockpiles, when we look at west of Suez, that'll keep things a little bit tighter. When we look at east of Suez, keep things a bit loose. And it's just a matter of, how does that balance out overall? So looking at this right now, when we look at total crude stocks, land and floating, you can see that the surplus widened from 8.2 million to 15.3 million, still above that 3-year average from 17 to 19. And still, but then when we factor in products, things also tightened a bit. So we had a deficit narrowed from minus 21 million to positive 7.3 million. So again, you're starting to see some of that deficit go away, and it's just a matter of when do we start to see some of this pivot from oil into products. So because you can see the total oil product stockpiles, the deficit narrowed from 29.2 to 22.6. We expect to see that deficit narrow a little bit more, given what we've seen so far out of Fujairah and what we expect to happen in Singapore, while the land continues to get drawn down on the total crude stocks. But there is a lot that is on the water that, again, is going to backfill that, both heading into floating storage, and as floating storage heads into onshore storage. Now, when we look at European gasoline exports, the Americas, again, staying fairly slow. So weekly exports of European fuel to the U.S. Right now were about 296,000 tons. In the weekend in November 6th and November 13th, which compares to an average of 395,000 tons in October. And we expect that to continue to slow, just given that the arbitrage between the two has essentially shut down, which again is going to be an important thing for oil product stockpiles. And that's why we look at what is happening in the U.S. as well as in Europe. So then when we look at land storage, this is where we saw the most bullish move. So the deficit widened from 37.5 to 38.6. And you can see that, again, it was on pretty much across the board. West of Suez had deficit widened from 24.8 to 29.3. Where when you look at the east of Suez, the deficit narrowed from 12.6 to 11. And we still expect the east of Suez deficit to continue to narrow. But again, the west of Suez is the one where we see this remaining at this point, just given where PADD 3 is, what's happening in Europe, and it's really east of Suez that is going to close some of that gap. But as we've been saying, we don't expect this huge surge. It's a fairly steady move going forward as the comps get a bit easier. So then when we look at floating storage, this is where we see some of the on the alternative side, the surplus narrowed from 38 to 23.1. And that's really because, again, that offshore to onshore is going to accelerate, and you have more crude in motion. So as more crude goes in motion, it gets pulled out of floating storage, and then that's why we look at oil on the water and oil and then break it out into oil in transit and oil in storage, because you want to pick up all of them. And then when you look at pretty much across the board, east of Suez still remains elevated. That's something that we think is going to remain, as we've been saying, fairly stable going into the end of the year. Where west of Suez remains a bit of an overhang given West Africa and what's happening in Europe with additional cargoes being stuck in the European markets. So then when we look at what's happening with driving data, here you can see that there was a nice bounce in Europe while everything kind of stabilized in North America. Rest of Asia got a little bit slower. And then obviously China still has those headwinds when you think about what is happening with COVID, the restrictions that are still there. Some of the spreads have slowed, but again, they still have a zero tolerance for COVID. So that is going to just mitigate some of these movements that we've seen. So we expect China to remain sluggish. And now Europe is an interesting one because there are COVID cases that are increasing in Austria, Germany, and France and the UK. So again, those are going to be things to watch. We don't expect broad sweeping restrictions. It's just, are people going to slow things down ahead of the holidays, or will they do a little bit less just to protect themselves? That's likely, but again, that's just something to watch. Google mobility remains fairly flat, as the Apple mobility data, again, really kind of tightens up and flatlines as we head into Thanksgiving for the U.S. So U.S. imports of European gasoline, again, just kind of after bouncing to that 5-week high, now they're starting to come back down. We expect that to continue into the end of the month. Consumers, when we look at propensity to spend, here's where we were talking about. You had that run up into Thanksgiving, into Christmas, trying to plan what you're going to do. And now we expect that to continue to roll over. But again, not this huge rollover, just see some of that normalize, which is what we were talking about with some of that spending getting pulled forward into October. So far, November is fairly stable. We'll talk more about this in the Econ show, but we expect November to be fairly in line with what we've seen over the last couple of months, which will be elevated. But again, October was that big month, and some of that spending in November moved into October. And this is showing what we've been talking about as this data now goes through November 7th. You get an idea that we see that trend continuing in terms of the reduction, which just means that we'll see a little bit less in November, and a lot of that was, again, pulled into October, but November still will be fairly strong. Now, when we look at total stockpiles, crude had a draw of 2.1 million. Yeah, that's still 59.6 million below the 5-year average. PADD 1 had a build. PADD 2 and Cushing also had a build. It was, again, the draw in PADD 3 of 4.87 million. that really made up all of that crude oil draw. West Coast had a small of 680,000, but as we've been saying, that's just a matter of timing between when does it get imported, when does it get run through the refiners. And when you look at PADD 3 is still 2.7 million above the 5-year average. So we'll see that work through. But it's going to be married with some of these imports. We saw imports go up. We expect that to be a little bit elevated, just given what the quality slate needs to be in PADD 3, because we did get an increase in refinery run rates, which is what we were expecting. And we think that that'll continue to trend higher. We'll probably get a little bit of a dip as we go into Thanksgiving, but then again, get back to normal as we head into the outer shoulder season and into winter demand. Cushing had a build of 220,000 barrels, and as we were saying, we didn't expect this huge surge, but a little bit of a stabilized. We thought it was going to be a little bit of a draw. Instead, it was a little bit of a build, but we do expect this to accelerate higher, especially as we go into the December contract expiration. And again, PADD 3 tries to keep that crude out of their tanks to avoid paying, again, tax avoidance, not tax evasion. There is a difference. So then when you look at production was fairly flat. It came down 100,000, but again, it's just going to be that moving piece as we wait for the Gulf of Mexico to fully come back online. And then when we look at the SPR had a nice draw, just over 3 million. And again, the draw out of SPR goes into commercial. So again, it's just a matter of the moving pieces, and we continue to see that draws from SPR, which is why it's funny when you look at what Biden is talking about of additional draws, even though we already have them and they've already been scheduled. And we will continue to see draws out of the SPR based on what has passed through Congress through the year 2027. So then when we look at oil inventories, excluding the SPR, here you can see that we've really flatlined. And this is something that I think is likely in terms of that flatlining as they try to manage some of these different flows. One of the things we thought it was going to trend a little bit closer to where we were in 2018. Instead, it's gone essentially sideways. And you can see that it's gone sideways before when you look at other years. It's going sideways at a lower starting point. So that's going to be one of the things in terms of where is the crude, how is it being operated. And we do expect, again, Cushing to continue to see a build, PADD 3 continuing to see draws as you get this rebalancing act ahead of the December. And then the November loading shipments of clean fuels from Asia to the Americas ticked up slightly, but still remains, again, above elevated, and we expect that to continue to come through in November. Less than October, but again, still seeing that creep up coming from Asia into the U.S. Days of crude supply, fairly stable. We're right at those 2015 levels. We're still below where we were in 16 and obviously 20, but very average for where we should be this time of year. And it's really, and you could say that, well, why is that? Well, when you compare where we are on storage and then where we are in terms of refinery run rates, that's where things average out. So run rates are still getting back to normal in terms of the 5-year average, but still a bit lower, which is why we have these a little bit, these elevated days of supply of crude at this point. Then when we look at oil storage and products, you can see that we were back to the lows for 2021. One of the things that we expect is, again, that adjustment for crude coming down, products starting to go up, getting some of that balancing act. We expect this to shift a little bit higher, but again, it's fairly stable at this point, really not much up or down in terms of where we see some of these flows over the next 2 weeks. Then when we look at gasoline storage, fairly normal when you think about where we are historically. One of the things that we expect is a bit of a pivot, especially as obviously after Thanksgiving, because at Thanksgiving is that big travel season. So we expect Thanksgiving to draw things down and then start to see those builds, especially as you have heating oil, diesel coming back into focus, and that'll throw off some of that excess gasoline that'll sit in the system. And then distillate, still the bright spot. Especially when you look at diesel, we still are importing more diesel from Europe, and it's really because PADD 1 is where we have that diesel shortfall, distillate shortfall, which we'll talk about in segment 2. And here you can see, again, distillate moving lower and still reaching the new lows for 2021. As jet bounces, again, jet is less of a struggle for us because we do see fairly stable demand. We don't see a huge increase or decrease at this point. And the refiners are going to try to balance between kerosene and diesel or distillate in terms of what can go in the different pools. And that's going to be how they'll look to manage. Curve is softened just a touch when you look at the front month, but has strengthened through the back end of the curve. Essentially, we're above 75 through the end of the year, above 70 through the end of 2022 into the beginning of 2023, and then above 65 through 2024. So still more than enough opportunity to layer in some hedges, if so desired, at fairly robust pricing, and just lock in some of that cash flow for not only 2022, but also 23, depending on what structures people are looking to use, because I know that E&Ps have said that they will not be hedging at this point in time. Then when we look at COVID, just because it's in the news and just wanted to flag where we see good and bad. So things in the U.S., again, fairly stable. Worldwide, again, fairly stable as things shift in terms of who is driving those increases. So the UK, again, still stubbornly high. When you look at what is driving the European case count a bit higher, it's Europe, it's Germany, it's Hungary. That's, again, it's just going to be regional in terms of where we see some of these reductions. Asia Pacific has flatlined. India continues to move in a positive direction as we have Vietnam and South Korea starting to shift higher, especially in Vietnam, while Malaysia is not really increasing, but it's not going down either. So it's just going to be, again, we're coming into COVID season. Instead of just flu season, we're now going to have COVID season, and here's I think one of those backdrops. And again, this is just going to adjust how people move about. If you're going to see family for the holidays, do you risk move around a bit less? And again, you're not going to lock yourself in your home. You're not going to fall under restrictions. It's just you'll try to do a little bit less to minimize your exposures, and that's why we just look at what some of that delta could be on where we are and where are we going to be versus 2019. PAD 3 inventories, here you can see still elevated, but below where we were in 16 and 20. But one of the things that we've been saying is we expect to move much closer to that congestion point of where we were in 18, 19, and 15, and that's where we'll probably close out the year. And by getting to that point, it's just going to be a matter of managing those imports while keeping some of that crude in the Gulf, in Cushing, the Gulf of Mexico, and trying to manage again imports, exports, and what will be left in PAD 2. And here's where we look at Cushing. This is just looking at the last 17 years. We expect to see this pivot higher along the lines of 2014. Not so much the pace will match, but again, it's not going to close the gap. We just expect it to look very similar to 14 as, again, more crude is left in there, not pulled down, and trying to manage those levels and getting a bit, zooming in a bit more and looking at the last 10 years. Here is where you can see that 2018 levels versus, I never thought we were going to get back down to 2014. The view was really, and again, it's going to be a matter, do we look like 2011 or do we look more like 2018? I would say that we look a bit closer to 2018 given how PAD 3 is going to manage some of their throughput. Runs increased 1.2%. We were expecting to get between that 87.5% operational rate. We came in at 87.9. So when you look at what drove that, it was all PAD 5. PAD 5 had an increase of 116,000 barrels a day. We're just 0.1 below the 5-year average. But that's still 621,000 barrels below the 5-year average. And it's when you look at what's driving that, again, PAD 1, PAD 3. PAD 3 is the one where we expect to close that gap a bit as they ramp up, drawing down some of that crude, creating some of that product. Now, if you think back to what they were doing with their nominations on the Colonial Pipeline, they were essentially keeping their nominations but just giving it away. And now that there's pricing back in, you're seeing a big increase in pricing going into the Colonial as there's competition to get some of this through. And that's where we expect to see more of that product, more of that competition. So as PAD 3 ramps up a bit, pulling in crude, creating product, sending it into the Colonial Pipeline into the East Coast. Then when we look at imports increased slightly by 85,000 barrels a day. That's still 824,000 below the 5-year average. And even though PADD 3 had an increase of 364,000 barrels, you can see it's still 859,000 below the 5-year average. And that's where we expect to see that remain fairly stable. And then when we think about the draw in PADD 5, you can see that PADD 5 also had a drop of imports by 295,000 barrels a day. And that's, again, that timing that we're talking about. And that's the imports is really going to be the delta on, is PADD 5 drawing or are they seeing builds? And then PADD 2 had a small dip of 178,000 barrels, but still remains 194,000 over the 5-year average, which will remain the case as we see more imports from Canada, especially given where the spread is. That'll keep things incentivized. So PADD 2 will see an increase. PADD 3 will continue to see a slow grind. It's just going to be a matter of marrying that with where are runs, where are exports, because they don't want to see big builds in PADD 3 at this point through the end of the year. Implied demand, as we were saying, we expected a little bit of a bigger pop in DISTI, but realistically, it's right around 70,000 barrels. That's where we think there's going to be that demand. Again, it's just going to be a matter of how big does it go up, how big does it come down. We expected it to come down a bit, but again, still remain above that 4 million barrels a day demand number. Came in at 4.3. This will come down a touch, but again, still, it could have a makeup number, but I don't think so. I think at this point, that 4 million should probably be the floor at this juncture, especially as weather gets a little bit cooler. You'll see a bit more pull through on the heating oil side, so that'll keep us fairly elevated. And then when you look at gasoline has a small decline of 18,000 barrels a day. Again, our view is that it creeps further to about 9.1. It's just going to be a matter of, obviously you'll have that elevated move next week as some of this product is pulled through in preparation of Thanksgiving. Then you'll see that big drop, and then you'll see a recovery as that product is moved back into the system. And then when you look at Resid had a nice bounce of 246,000 barrels a day. Jet had a drop of 206,000 barrels a day, which is what we were thinking. We're getting a little bit closer to that 1.4. We do expect to see that bounce though over the week. And then when you look at floating storage came down a touch. We expect that again to creep a bit higher as they try to manage those imports. And when you think about imports increasing, that brings down floating storage. Now there will be more room for that floating storage to come through. Again, not getting to the 5-year average, but still staying at the lower end of that cloud. Then when you look at PADD 3, here's that bounce. We expect this to continue to grind higher. Again, not getting to the highs that we saw at the end of September, but just closer to the middle of that range, just given where activity is. We will see some of that increase in run rates, so that they will require that imported crude for that heavier slate. Then when you look at PADD 2, as we were saying, we're going to stay well above the 5-year average. We made a new seasonally adjusted all-time high, but again, it's still off the highs that we saw last week, and we just expect this to remain elevated well above the 5-year average and just staying either at the top of the cloud, above the cloud, or just in, again, that top end. And then when we look at what's happening for utilization rates going over the last 29 years, you can see that we're just closing that gap, and we just expect it to be very close to, if not right on point, with where that dotted line is going into the end of the year. So now we went through a bit of that overview. We want to dig into each specific product in the U.S. That's gasoline, distillate, jet fuel, propane, and ethane, just given how important obviously the refined products are, but also the liquids in terms of U.S. consumption and those export levels.